company that I created. The television company would sell TVs for $600 a pop. This would only include, of course, a special size TV because different TVs can be different sizes. Variable costs to keep these TVs running all day at the store and maintaining them and whatnot would turn out to be, let's say, about $325. Total fixed costs come out to be $50,500. And we sold a total of approximately 600 televisions. So these are the projections for the month of November that we have. $600 per TV, $325 unit variable costs. The total fixed costs come out to be $50,500, and the units sold equals 600 TVs. With this, we can make a CVP income statement. We can start by calculating the sales. For sales, we would multiply the unit selling price of $600 times the amount of units sold, which is 600, and that equation ends up equaling $360,000. Variable costs now come into play, and these costs are costs that can be changed during the period, like the amount of electricity used or the amount of water used. To find the variable cost, you multiply the unit sold of $600 times the unit variable cost of $325, which equals a total of $195,000. Now the contribution margin joins the fray. The contribution margin is the amount of revenue that remains after you deduct the variable costs. So we have our sales of $360,000, and you subtract the variable costs of $195,000, which gives you a total of $165,000. Another way to calculate this is to subtract the starting variable costs from the starting selling price. So our starting selling price is $600, and we subtract $325 of variable costs to give us $275. We can then take that and multiply it by the amount of units sold of 600, and we would get $165,000, same as the price we would have as before. Fixed costs have not been accounted for yet, so let's talk about those next. Fixed costs are costs that remain the same regardless of the changes in the activity level. We take the fixed costs of $50,500, and that's subtracted from the contribution margin of $165,000. That we found previously, of course, which gives us a net income of $114,500. Next comes our profit, which is what people typically judge a company on. We use the format formula to calculate the total profit. We start with the price per unit multiplied by the volume, which is the amount of units that were sold in the period. So we take the $600 per TV times the 600 total sold TVs, and that gives us $360,000 like we had before. We next do the variable costs per unit of $325 multiplied by the volume, which is the amount we sold, to get $195,000. And you subtract that from the $360,000 in sales, but you must also subtract the fixed costs. So it ends up being $360,000 minus $195,000 minus the fixed cost of $50,500, which totals our net income of $114,500, just like we had previously calculated. So I would end up earning $114,500 if this were my business.